Uh, Great. So I'm Nalin Moniz, and I look after the alternative equity business at Edelweiss. We are one of the largest alternative asset managers in India, and I've seen the journey of the alternatives business and industry in India really boom. I helped to create the first AIF in 2012, and never in my wildest dreams did I think that a 20 crore fund would grow into a 4.5 lakh crore industry. And I think the best days are still yet ahead. And I'm looking forward to sharing that story with you guys later today.
So thank you so much. And given your past track record, you have been an avid marathoner, a globetrotter, and you have also graduated with a BS in economics from the Wharton School and a BSc in computer engineering from the School of Engineering. And you have also managed the world's largest hedge fund, Global Alpha, while still at New York's Goldman Sachs Asset Management in the mid 2000s. And you were also the co-founder for Forefront Capital Management in India, one of the leading public market alternative boutique. And Forefront Capital eventually got acquired by Edelweiss Financial Services arm in May 2014. So, given this background, I'm sure that there must have been some impetus to you to leave a high-paying job in the US and coming back to India and starting a fund management company. So, what brought you back to India?
So I'll give you an irreverent answer, Darshan, which is that as you can tell, I've always been gainfully employed, no unemployment stints on my resume. Uh, but, uh, I came back to India because I think this is home. This is where the future is. And, even though I had a great gig at Goldman Sachs in New York, the chance to create something from scratch in India and build an industry was exciting in 2009. It was exciting in 2014, and it's even more exciting in 2021.
Great. So glad to have you here, sir. And so apart from that, like coming to our episode, could you just give our listeners a brief overview on what is equity alternates in general?
Right. So the equity alternatives are basically a whole bunch of non-traditional funds in uh, the listed equity space. Uh, I think it's best to understand equity alternatives by understanding what it is not. Traditionally, investors have invested in a variety of equity mutual funds, large cap, mid cap, multi cap, so on and so forth. And what those funds do is that they just buy and hold 60 to 70 stocks in a portfolio. Uh, in equity alternatives, we look at more focused portfolios, which has the fund manager's best ideas, maybe some amount of leverage, some amount of shorting, some amount of trading, a lot more dynamism than what a mutual fund may bring. And hence, this makes it a very interesting option or alternative, to use no pun intended, for for investors.
Right, great. So, what falls under this majorly are PMS services, that is portfolio management services, and AIFs, which are alternate investment funds, right? So, this is for our listeners that we'll dig deep into AIFs in the coming segments. So, hang in there with us as the AIF maestro is with us today. So, moving on to the third segment. So, I think I'll hand it over to Darshan then.
So, post the 2008 financial crisis, the equity markets have grown a lot, but the comparison cannot be, taken with the AIFs. The return on the AIF investment is still low as compared to the traditional investment asset classes. So, how do you take that? How would you like to generate returns through the structure that the AIF gives to the audience?
Right. So I think this is one big misnomer, Darshan. Um, so the role of equity alternatives is to provide more steady returns. You know, in the last year, for example, equity markets have boomed and a lot of funds have done well. But you also have to remember that in financial year 2020, uh, it was a year where the Nifty was down 25% and a lot of funds had struggled. And if you put both years together, a good year and a bad year, uh, right, the experience of investors may be less than happy in traditional equity funds. Uh,
Yes.
but in equity alternatives, it's not as much of a roller coaster. It's a more steady experience. And funds did very well in FY20. They did less well in FY21. But put together, the 2 years are looking very good. So I think this plays a very different role in a client's portfolio. It's for a more steady, a more conservative investor, and maybe an investor who has made money the hard way in a business or in a venture and is looking for capital appreciation, but equally a good night's sleep every night.
Right. So since we're comparing it with traditional assets over here, so I remember I was in a conversation with Ashish Somaya of White Oak Capital Management, and he'd mentioned that AIFs in particular have this cuteness of mutual funds and the investment latitude of PMS. So could you please throw some light on what is this mix of mutual funds and PMS that AIFs offer to investors today?
Right. And Ashish is spot on.
Yeah.
Okay. One of the reasons that the AIF industry has grown so fast, and today you have more than 700 AMCs present in the AIF space, is because it combines the ease of a mutual fund with the freedom and flexibility of a PMS. I'll explain this a little bit more. It's easy. Investing in an AIF is almost as simple as investing in a mutual fund. All you have to do is sign a 2-page document, give us a KYC, and you're good to go. There is no bank account, there is no demat account, there is no broking account to open. And in terms of the statements that you receive every month, the fact sheets, everything is standardized. Even for a fund manager like me, it's super simple because there's just one portfolio to manage. Okay. However, so that's the ease of a mutual fund, but it has a lot of freedom that a mutual fund does not have. In the case of category 1 or 2 AIFs, it can invest in unlisted securities. In case of category 3 funds, you can do shorting, you can do leverage. You don't always have to be fully invested. You don't have to hold 60 to 70 stocks like you do on the mutual fund side, and so on and so forth. So it gives the fund manager a lot more freedom, creativity, and flexibility to manage the portfolio. So I think, Ashish is absolutely right. This is the best of both worlds. And that's why you've seen things grow so fast.
Right. So this is just for our listeners that according to the new SEBI rules, the minimum ticket size for an investor to invest in a PMS is 50 lakhs, and to invest in an AIF is INR 1 crore. So, Nalin, you just talked about category 1 and category 3. So could you just take us through all the three categories for the listeners, please?
Right. And I wish these categories were named something a little more interesting, but this is the classification by SEBI. Category 1 AIFs cover venture capital funds and infrastructure funds. Now, the two have nothing to do with each other, but they are clubbed together in category 1. So these are funds that are, getting either investing in startups or In the case of infra funds, investing in roads, power projects, transmission lines, etc. Category 2 AIFs include real estate funds, credit funds, and private equity. And here they're either doing some kind of lending activity in the case of credit funds or real estate funds, or they're investing in more mature startups right before they go public. And category 3 deals with the listed space. Here, funds are either long only, okay, or they can be long short, so taking bets on both companies that will do well and companies that will do poorly. So that is the broad classification. And as I said, I wish these names were a little more descriptive.
So given the classification we just heard from you, I'm sure managers take a certain level of leverage, also account to a certain level of risk, which is also, investors do look forward to when they start investing. So how would you think that portfolio managers should, take account the amount of leverage that they have taken to reduce the risk?
So, Darshan, first of all, by SEBI regulations, leverage is only allowed in category 3 AIF, and it is capped to 2 times. 2 times means that if I'm managing a corpus of 1,000 crores, my positions cannot exceed 2,000 crores. Now that is far less than what you can do as an individual investor in a broking account. And that makes sense because you are managing third-party money. Now, in practice, out of the 130 to 140 category 3 funds that are available, I would say that only maybe 10 to 15 funds are actually using any form of leverage. And even then, it is very modest, maybe from 1 to 1.5 times. Okay. So funds are not using a large amount of leverage. And I think the fact that the industry has gone through so many periods of volatility, good and bad, take demonetization, take, Modi being elected twice, take the March 2020 crash due to COVID, right? There are so many examples in the last 8-9 years, and we have not had a single blow up or a single big failure in the industry. And I think this should give investors confidence that the rules that SEBI has put into place are very prudent, very sensible, and also fund managers are doing very, very sensible things.
Right. So I have a two-parted question now. First is that what I hear from you is that AIFs are definitely, more attractive to investors today. So why is it that they are attractive? Is it the transparency that's involved, or is it the freedom that's involved? And secondly, if they are attractive, I mean, given that they are attractive, there is also risk involved, right? So given the leverage that is there, even if it's 2x. So I've heard from fund managers that, they are risk managers first and then return managers. So their first priority is capital preservation and then generating returns. So with that said, leverage coming into the picture, does that still stay intact or not?
Yes. So I think, Charmi, you expressed it so beautifully that fund managers are, risk managers first, return managers second. Because at the end of the day, it's not a number in a spreadsheet. You're managing somebody's hard-earned savings, right? AIFs are not risk-free. Frankly, no investment is risk-free. If you're investing in category 1 and 2 funds, then you're making long-term illiquid investments, and that is a key risk factor in those kind of funds. In category 3, which deals with the listed space, because you may be running a concentrated portfolio, there may be periods of time when you dramatically underperform the benchmark. And of course, on the long short side, both your long and your short bets could go wrong, and you could deliver negative returns. So, risks are there, and it's important for all of your listeners and all your viewers to understand that this to go into these investments with their eyes wide open.
So I think AIFs as an investment class has grown remarkably well in the last 1.5 years, given that Geo has been able to raise more than $20 billion from foreign portfolio investments. And the second one is that startups have now been classified under the priority sector lending by the regulations in India. So how do you look forward for AIFs, and what kind of funds are able to give better returns to investment managers? Is it the IPO funds or the startup funds or the infrastructure funds? Which would be the best ideal fund to move forward within the next 5 to 10 years?
So Darshan, as I said, I am super excited about the AIF industry and the growth prospects for alternatives in India. There is no single right fund, okay? Just like there is no single right mutual fund. Mutual funds come in all shapes and sizes, ranging from a very safe overnight or liquid fund to a very high risk, high return small cap fund. Likewise, AIFs come in all avatars and all risk return characteristics. But there is activity happening in all of these categories. There is a lot more action happening in startups, so money coming into VC funds. India is starved for money for infrastructure, and hence there is a big opportunity for infra funds. Credit activity is moving away from NBFCs and banks to AIFs. Many of the same startups that are funded by VCs are staying private longer, and hence there is more demand for PE. And lastly, as I said, in the listed space, there is a lot of innovation, a lot of new ideas like equity long short that are bringing interesting funds to an investor's portfolio. So I'm super excited about everything.
Okay, just changing track slightly over here, and kind of coming to the tax implications as well as the coming in of NRIs into AF. So, is it really, what are the regulations, rules, and protocols of bringing in NRIs? Is it difficult? Is it easy? Also, what impact has Brexit created, and what will it bring in? And other tax implications aligned to what our domestic to what our home country also kind of so one thing that I know is that taxes are charged at the funds end. So the returns that an investor generates from an AIF are post-tax, right? So what are the protocols on the same on the same lines for NRIs, and what are the implications for the same?
Right, Charmi. So first of all, Brexit does not have any impact, on any of this industry or any of this growth. Secondly, NRIs are allowed to invest in AIFs, but it is on a fund by fund basis. So there is no general answer. People will have to, some funds allow NRIs, some funds don't allow NRIs. Okay. And number 3 is that taxation, which is very important, it's a very important topic, is at the investor level for category 1 and category 2 AIFs. But in category 3, it is the fund that pays tax. Okay, so a little bit of nuance there. Uh, Personally, in category 3, which is where I focused, I found that it is very convenient for NRIs, because if the fund is paying the tax, then the NRI doesn't really have to worry about getting a capital gains statement, talking to their chartered accountant, etc., etc. It's very, very simple. But it also makes the fund manager's job a little bit tougher, because you have to manage tax in addition to managing investments.
So as my co-host rightly pointed out, a few, regulations that govern AIFs, and you just said that it sometimes becomes difficult for managers to, allocate the funds correctly. So given a chance, what would you change one thing about the, AIF industry or the way AIFs are structured so that, you can allocate the funds in a much better or efficient way? What would you
Right.
change that one thing?
So at least in category 3, I would love the tax to be at the investor level, so the fund manager can focus all their attention on managing the portfolio, not on managing tax.
Also, this I'm not sure of, but I've just heard while being part of a lot of conversations, is that most fund managers also kind of crave for a regulatory body to kind of smoothen the flow of alternates. So what is the niche over there?
I completely agree, Charmi. I am a big believer in regulation, and I think having a very sensible and wise regulator like SEBI uh, only helps us to build a better business, because it gives a vote of confidence and it gives a stamp of credibility to the fund manager.
Okay, so yes, that would be it for the third segment. And now we would like to move on to the fourth segment, where we'll throw words at you and it would be a quick fire round. So you'll have to reply as fast as you can.
Okay,
Done. This is your version of Coffee with Karan.
yeah, and I'm sorry to
Yes.
interrupt, but I think given the marathoner that we have in him, speed is not a question for us for this round, right? I'm betting
Well,
on
Yes,
we'll
yes,
this.
see,
sure.
Charmi. We'll see.
Yeah, yeah, yeah.
Okay, so the first word is VC fund.
Uh, Exciting.
SEZs.
Uh, a big opportunity.
Angel investing.
Uh, a lot of fun.
Long only or long short?
Long shot.
Traditional investments.
Boring.
Concentrated or diversified portfolio?
Concentrated.
Risk return trade-off.
Uh, Always keep in mind.
SEBI.
Super.
The last one from my side would be Goldman Sachs Asset Management Company.
Great place to start a career.
And last one from my side would be Indian economy.
Uh, Great prospects.
Great, great.
So thank you so much for being a part of this podcast. And we would just like to conclude with a few questions. And from my side, it would be, if you had, if you had the opportunity to turn angel investor at this point of time, which would be that one company that you would gun for or root for and put all your money on that company? Which would be that just one company?
Right. So I think the company that I'm most excited about is run by a friend of mine, Basant Kamath, which is Small Case. I think they're doing super stuff, and you know, Small Case will be a unicorn uh, and be truly disruptive in financial services. So power to Basant and his team.
Great. I'd like to ask you an extension of the question that Darshan asked you during the introduction. So, we saw that you moved back to your home country and started a business here. Given a chance at this juncture to run a business in the West at a very popular company, XYZ company, would you take that chance or not?
No, I think that India is the place to be.
All right. Okay. Thank you so much for coming
Thank you.
over, and thank you for being a part of the finale of Economically Yours. We really appreciate it.
Thank you, Charmi. Thank you, Darshan.
Thank you
Thank
so
you.
much for
Yeah.
being a part of this podcast.